Good evening again, everyone. My name is Gregor McDermott. I am with Cyber Trading University. I welcome you to our free webinar this evening, brought to you by FXCM. FXCM is our FX sponsor, great brokerage firm. They are going to provide an offer at the end of this, probably going to touch on it in a minute. I'm going to be teaching a class next week, Monday, Tuesday, twice a day, covering a number of different topics. But I just want to welcome everyone. We're going to go through the formality of going through disclosures and all those kind of things, and then we will get our presentation going. The risk disclaimer, which you're all very familiar with. This is a risky, can be a risky business, trading your own money, trading your own capital, which is why education is so important, and why we recommend that when you start trading, you start trading in a demo account. Take some of your lumps without your hard-earned money on the table. So there's our disclaimer. About Cyber Trading University, we've been an educational trading institution since 1995. CTU established itself as a leader by first working directly with the SOS trading firms, teaching them to day trade. I'm old enough to remember when they used to call them the SOS bandits, and those SOS bandits paved the way for what you and I today know as individual investor trading. They sort of broke down that wall and opened the door with the advent of personal computers and the internet and exchanges to become part of the financial market, and that's why we're here today. CTU was the first to establish, or one of the first to establish itself as a quality stock market trading school. Each instructor, including myself, has a minimum of 6 years of actual trading experience before they begin to work with students. And over the past 14 years, we've taught thousands of students to be successful and profitable traders. Headquarters for CTU, as I said, is back in New York. Greg is there manning the ship as we speak. About me, probably the least interesting thing we'll talk about this evening, or at least for me. Again, my name is Gregor McDermott. I earned a master's degree in applied finance at Macquarie University in Sydney, Australia. Always like to see if there's anyone checking in from down under, of course. It's in the morning there now. It's probably about, I think it's 10 or 11 in the morning. They're about 15 hours ahead of us here on the East Coast. Earned my bachelor's degree from St. Joseph's University. Hopefully everyone who is part of the March Madness phenomenon here in the United States has picked my Hawks to beat UConn. Just a personal note, that game's Thursday. Crude oil options trader at the New York Mercantile Exchange, head options market maker at the Philly Stock Exchange for JAS Securities, a privately held trading firm. I managed the firm's option portfolio on the floor, had about 10 traders and myself that I was responsible for the performance to the partners. Was a market maker myself in the Dell computer crowd. And back then, Dell was the busiest equity option traded in the United States. It was before multiple listings, and we had the single listing for Dell. Dell was think Google, think Apple. That's what Dell was like as a volume trader back then. Also directed an off-floor trading unit for JAS and was qualified at that point by the ISE to be a DTR, to be able to be a market maker on the ISE. So we are going to get going. Wanted to mention to you tonight's webinar and the other ones, if you've been part of the series that we've done this month, brought to you by our friends over at FXCM, and they are offering you the opportunity to continue your education with me next Monday and Tuesday, 5 o'clock and 8 o'clock. And unlike a lot of the packages that you've probably seen and a lot of the courses that you've probably taken, which are singularly focused on one specific topic, we're going to kind of draw on my unique background as an equity options trader, as someone who's taught graduate derivatives, someone who's traded currencies, very familiar with the currencies market. And it's going to bring us back to kind of the core belief that Cyber Trading University has, is that education is paramount to your success. And the majority of things that you learn about risk management, discipline, how to be a trader can apply across underlying securities, whether you're trading equity options, currency options, whether you're trading straight equities, you're trading foreign currency spot, you're trading futures. The same general principles apply. Yes, there are idiosyncrasies between each of the different individual underlyings, but in general, the same sort of mindset, the same discipline, the same work ethic can bring you success regardless of what you're trading. And what we're going to do with the triple play is we're going to talk in depth about options. We're going to talk about equity options and how you can make money using them. We're going to talk about FX options and how you can make money using FX options. I'm really surprised how underutilized the FX options market is, considering the built-in safety with the ownership of options, contrary to what a lot of people believe. I know Mr. Buffett right now has the $1 billion challenge out for March Madness. If someone out there can fill out a perfect bracket, he will pay them $1 billion. He's also the man that was famous for saying that derivatives can be the weapons of financial mass destruction, and they can be used improperly. We're going to teach you how to safely and effectively take advantage of all the good things about options, minimizing your risk, and being allowed to stay into trades. And we're going to talk about all that over the 4 hours that we're together. If you join us next week and open up an account with FXDM, it's really a $37 course. Less than $10 an hour to get the experience from someone, me, without trying to pat myself on the back, who's probably, for your benefit, made more mistakes and more bad trades as well as good trades than all the people on this call combined. And I learned a lot over the years. And I'd like to help you limit the amount of mistakes you make from what I've learned over the years and become successful traders. This is not something where we want to tell you that there's magic. There's no black box. There's no magic. This is about hard work. And if it were as easy as every time I trade, I make money, if anyone tells you that, they're not telling you the truth. The reality is you have to learn. You have to be educated. You have to use a demo account. You have to try to get as much information as you can from different areas, find a trading style that works best for you. And that's what we're going to talk about in the triple play course. We're going to talk about options. We're going to talk about equity. We're going to talk about currencies. All those things work together that can help you build a trading base from which this job, this is not magic, this job that you're taking on can help you be successful. And again, the advantage of FX is that the job can really work around your schedule. And even options allow you, done properly, to manage trades and work trades without necessarily having to be in front of a computer all the time. So that's what we're going to do next Monday and Tuesday, 5 o'clock and 8 o'clock Eastern time. I look forward to all of you joining us. I'm going to get going with our presentation now. We're going to touch on this again. We'll also give you the link, the triple play package link at the bottom. You may see it show up in the chat window. I'm sure Greg will throw that up there for you, and we will move on with the presentation. We're supposed to start with equity option based, FX options basics. We're going to talk about options, but I'm going to deviate a little bit from the program. There's a couple of things going on in the FX market right now, and I just think there's a couple of trades that are out there, and I'm going to start by saying, please, please, please do not do this in anything but your demo account. But there are a couple of trades that I've got working in our demo account that I just wanted to relay to you, give you an idea of what's going on in the market right now. So again, here's the warning. This is for educational purposes only. I'm going to share my desktop with you. And in a second, you're going to see my desktop show up. And there it is. And the three trades that I'm looking at, I'm going to give you one that I've got pending, and then two that I've got in. Again, this is my demo account. This is for educational purposes only. Please do not be laying out your hard-earned money. But since we've been talking, if you've been with us for the last three sessions, including our live session, I just wanted to give you another look in the methodology of how we go about it, what sort of things we look at. The first one I want to look at is the US dollar, Japanese dollar, pardon me, Japanese yen, I apologize. Been a long day. So here's what we've got on right now. We have a trade out there in our, I'm going to give you the 15-minute chart to show you what I'm looking at. Well, actually, let's go backwards. We're trying to play, the basic theory goes, we've got the Fibonacci line here right at 50%, which is just below. And again, we're looking at a daily chart here, so you have to worry about scaling. What I'm trying to do is find an area where I can buy and catch a reversal and a continuation of this upward move that we saw. Let me draw my pen in here so we can show you. One of the ideas behind a Fibonacci is that we're going to test some of those key Fibonacci levels. And right now, this 50 level right down here, this red line here where I've poorly drawn a little line, is an area of and should be support. Part of the reason why we've got a pivot over here, we've got a pivot low here, and another pivot low down here. We've got a lot of support areas now. And again, it could break it, but here's the idea on the trade that I'm looking at. Right now the underlying's trading at 101.432, so 101.432. And to be honest, it's a little bit more of a stretch. I'm not that comfortable trying to get in, so I'm trying to play a move up to this area. And if I'm looking at it here, down to about my lows here, I don't want to put 50 or 60 pips out on this trade just yet. I'm trying to find a better entry. So what I've done is I put in a buy, and it looks a little bit better on this one. You can see I'm looking for this area right in here. I'm trying to get this to come back into an area of support here and make a buy. I've got a buy in at 101.28, which is about 15 pips below where we're trading right now. Could I jump in and just buy this? Yeah, I could. But part of the reason is that I'm waiting is I'm looking for an area where I've got the odds a little bit more in my favor. And if you take this out to, say, a 1-hour chart, you can see that there's a serious amount of support down in this area. And I've got a stop that's below, I think the stop's at 100.88. So I've got about a 40-pip stop. I don't want to take that up to 60 pips because my upside, I really only think I might be able to get, if I could get a purchase here, 80 or 90 pips to the upside. I prefer not to have a 60, 70 pip downside, 80, 90 pip upside. I like to have a little bit more leaning my favor. So if I don't get in this trade and it gets away from me, it gets away from me. But I'm looking for it to retrace, maybe even get back some of this big move we saw, and this is a 1-hour chart, back on the 13th, back on Thursday afternoon. So trying to get back into the, say, 102.55 level. So what I did there was I've got a pending order. I'm trying to catch a little bit of a move when the market opens up in Asia, if I can get in. If I don't get in, I don't get in, and then I'm willing to let that happen because I don't necessarily want to jump on a trade that's a little on the dicey side. And you could see on this daily chart, you could make an argument that this thing is rolled over and maybe it should be a downside play. I like it to the upside, and that's why I've laid that trade out that way. The other two that I'm looking at, and if you look at the bottom, we've got them both in. The first one is the pound dollar. Looking at the profile. And again, if we go to a 15-minute chart, then you've got, this is our entry line right here. I'm going to highlight it. Oops, didn't want to do that. I moved my stop. I didn't want to do that. Let's get this back up here where I wanted it. There we go. Sorry about that. And what I did is I'm trying to play. This really almost comes out to me, and I got in early just because I knew we were going online. I didn't want to leave it, but this might be something where you would consider, and we may talk about this in a couple days, kind of a breakout trade. If I wanted to get in the trade so I could look at it with you guys, but in reality, you might be better off putting a buy stop up, say, in this level. Once we clear here, to try to catch this upside move. Now, I got into this one a little bit earlier. I knew we were coming online. I wanted to show you, but I've got my purchase here. I got my stop down here, so I'm about 65.44 and 65. I got about a 50 on the downside and about a 50 on the upside. It's kind of a one-to-one up and down trade, but we're trying to get a looking to retrace this movement back. I've been watching this for a couple of days. Honestly, this one seems to have gone on forever. And then the other one that I'm looking at is, as a reminder, this is for educational purposes only. Please, please, please do not be putting your hard-earned money out on these trades. Here's the other one. It's the euro versus the pound. if you look at it on a daily, this thing is, again, cleared a lot of the resistance in this area and is now kind of making a move, and you would think probably going to retrace up to maybe these pivot highs and try to fill that area. So I went in on the 15-minute, and I've been watching this one for a couple of days, but on the 15-minute, you can see where this is where we got in. I'm sorry, this is our downside. We're about, that's 0.8377 versus an entry of around 0.8395. It's a very tight stop because you can see if we break, I'm gonna hit it here, if we would break this support, you know, very likely they're gonna take out my stop, and I was wrong, which is why I made it a tight stop. I don't have a lot of money on the table, a lot of risk in the demo account, but if you look at it on the hourly chart, our upside is, I'm sorry, where did I put that? The 4-hour chart. It's got the, our take profit on this one is up at the 84.60, so it's even above this area, because once we clear it, it should really break and run. If you look at this, it's up around this level. So there are 3 trades that I'm looking at right now. I want to make sure that everyone understands that it's educational purposes only. 2 of them are live. Full disclosure, if you look at the bottom, one's down $139 on a 2 lot. The other one's down $44 on a 2 lot. I told you, every time I seem to do one, show you guys something, I end up losing on the trade. So if you choose, you want to follow this, write down the numbers, write down the trade. Again, it was the pound versus the dollar on the upside. It was the euro versus the pound on the upside, and then happens to also be a buy in the dollar yen. If you want to track them yourselves, a little bit of fun paper trading, keep an eye on that. I know that's a little bit off course from what we were talking about, but I think we need, just wanted to note that to you guys. I'd seen some of those things and figured I would share them with you as we got going. Tonight we're going to talk about FX options, something that you probably are not very familiar with. The fact that they trade listed on 2 different exchanges. They're similar to an equity option. There are some differences. We're going to go over those now. And then we're going to talk about how could you use them and implement their trading strategies to help you in your everyday trading. Guys, give me 1 second. I'm going to take a drink of water and I'm going to do it in your ear. Thanks, guys. So FX options basic. What is an option? This is going back to square one. Options are contractual agreements to buy or sell. In this case, we're talking about equity is stocks, but it can be any underlying that has an option or a currency at a specific price over a given period of time. It is a derivative instrument. What's that mean? It means that the value of this derivative is, shockingly, derived from the value of something else. You determine the value of an equity option by the value, in part by the value of the underlying security. It also is, the price is also affected by timed expiration, the strike price, and volatility. So all 4 of those pieces come together to give us, in a simple form, the value of an option. The danger really depends on how they are used. You can put yourself in a very, very, very risky position trading options. Most brokerage houses will not allow you, unless you can show significant amount of funds or experience, they'll put you in what we call a naked short position. What does that mean? That means you are short, you've sold options without an underlying hedge. Very risky position. Trust me, I know from experience. It's not a lot of fun battling a negative gamma short option position. They can be very dangerous. But the reverse of that is if you're using options that you buy, you mitigate and know your risk as you enter the trade without any further risk to your capital to the downside. And originally, options were created to hedge risk. Some would say that it's gone well beyond that, and options and derivatives now can ramp up risk. But it also can be used as a hedging tool, and a very effective hedging tool, if you ask me. Now, I'm completely biased. Traded options for a very long time, know them really well, and understand how they can be used for good rather than evil. when we're talking about long options, what I mean by long is ownership. It's not necessarily which way do I want the underlying to go for me to profit, but long meaning I own the options, which is pretty much the only way I would suggest anyone on this call, on this webinar, ever, at least as they begin trading, open an options position, which would be from a long or ownership side. If you are long a call, you, the owner, have the right but not the obligation, and that's key, to buy the underlying security at a fixed price over a given period of time. They got this from the idea that you could call away the underlying from the owner. The key to this definition, and you may, when you hear people talk about options, they don't stress this, and I do, is that you have the right but not the obligation. If you're the owner of the option, you get to call the shots, and for that you pay a premium, and it allows you to determine when and if you're going to exercise the right that you've paid for. If you own a put option and you're the owner, that owner is given the right, again, same thing, but not the obligation to sell the underlying security at a fixed price over a given period of time. The fixed price being the strike price, and the given period of time is until expiration. They call this putting it back to the owner, selling back to the owner at a certain price, the underlying, whether it be an equity, a future, a currency. This is what the profit chart in its simplest form for being long a call, the P&L looks like. And what we find is that as your break-even point ends up being right here, and that's the point at which, in this example, it was a $4 option on the 50 strike, and the underlying has increased. And again, I'm not going to explain to you why I know that, but here's what I'm telling you. When you own the option, as the price goes up, that's the way that you make money. And this trade, until you get to $54, you're losing money because you've paid $4 for the right to sell, to buy something at 50, and if it's worth less than 54, why would you do that? So in a long call, you make money on a move to the upside. You clear out the bad drawing for you. A long put looks very similar, but the difference being your profit increases as the value of the underlying decreases. Let's think about that from a logical standpoint. If you have the right to sell, in this case, the underlying at $50, and you paid, it looks like you paid $4 for that right. If the underlying is trading at $50, there'd be no reason for you to sell it at $50 when you could just sell it there'd be no reason to sell it at $50 if that's the current market. But let's say the underlying price goes to 40, and I always stop with puts because it's kind of counterintuitive for a lot of people, but 40 is right about here. If the underlying is trading at 40 and you have the right to sell it at 50, well, there's a $10 value there. Now, you paid $4, so your profit, again, in this simplified version, would be $6. So you would make $6, and you can see, shockingly, draw it across there, pretty much except for my bad drawing, there's your $6 profit. And again, this would go all the way until the underlying hit 0, and at that point, your profit would be $46. Why is that? You can sell it at 50. The cost you $4, so you could effectively sell it at 46. It's now worth 0, and the person who sold it to you has to pay the $50, and they only got $4, so they're out of pocket $46. So again, once you're the seller, you're obligated. So that's the key differential between ownership. It's that the owner has rights, but not the obligation. The seller has obligations. Here we go. Short. When I'm talking about short options, again, I mean, you're the seller. You're not necessarily naked short because you could have a corresponding long position against it and be hedged. But this idea of an individual line or an individual underlying option being short means that if you're short calls, It gives the seller the obligation to sell the underlying security at a fixed price over a given period of time. So what does that mean to you? Well, it means that you've given up your rights in exchange for a fee, and you can take that fee and put it against any losses you may have and hopefully end up with a winning trade. But you're obligated until the contract expires to fulfill the contract. And the same thing with the puts. As the seller of the put, you're obligated to buy the underlying security at a fixed price over a given period of time. In our last example, if you took $4 and sold me the 50 put, and the put is not expired and the underlying goes Enron and goes to zero, you have to pay, I get to sell you the underlying at $50, but I paid you $4 ahead, so my effective selling price is $46. You lose $46 on that trade, and there's no, unless you have a corresponding hedge, you have to honor that because you've traded your rights into obligations in exchange for a fee. Here's that profit on a short call, and as you'll see, the area where you profit on being a short call is only this area here under between the horizontal axis and the red line. Anywhere below, when the underlying goes up, your profits go down. And again, it's the inverse of the long call that we saw a minute ago. This is pretty easy for people to understand. The one that always gets really kind of dicey is this one, the short put. It's just kind of counterintuitive. Most people are used to coming to us from an equity, a stock trading background, where up equals profit, down equals loss in a very absolute way. Well, in options, it's really two-dimensional. You can make money on the upside or the downside, and you have to be aware of the advantages. But if you just think about this, and we'll take a minute because it's really kind of counterintuitive. You make money, if you're short puts, you make money here underneath the red line and above the axis. But as the underlying goes down in price this way, you can see your profits go the same way, down. So as you're short the put, as it goes down, you're losing money. And again, your break-even point in this scenario looks like it was a $4, the 50 puts at $4. So just a quick look as to how the P&Ls are laid out if you're looking at calls and puts. Quick recap here, long and short, again, we talk about that meaning ownership, not necessarily directional profit bias. If you're long a call, you have the right to buy. If you're long a put, you have the right to sell. The opposite of that, being short a call, you're obligated to sell. Short a put, you're obligated to buy. In a currency pair, long calls have the right to buy the pair. Short calls have the obligation to sell that currency pair to the underlying. Let's talk about where can you find options. Now, again, we touched on equity options, but we're going to focus now on currency options. Where can you find FX options? How can you avail yourself to be able to trade? Now, if you have a regular brokerage account that has options capability, you can already trade FX options. You don't need a special FX brokerage account at almost any major brokerage firm in the United States. So let's talk about them. The world currency options are from the PHLX NASDAQ, which is where I came from. They were founded, I guess they've been trading them now for about, I don't know, probably about 7 or 8 years, something like that. And you'll notice something specific about the way that these pairs are set up for the world currency options and then the corresponding ISE options. It's the pound versus the dollar, the euro versus the dollar, the Canadian dollar versus the US dollar, again, USD being US dollar, the Australian dollar versus the US dollar, the Swiss franc versus the US dollar, and the Japanese yen versus the US dollar. You'll notice that all of those pairs have the US dollar as what we would call the counter currency. When you're looking at currency pairs, the first one that you see is the base, and the second is the counter. We touched on that in our previous classes. So everything here is based in US dollars. So for anybody who's familiar with the Japanese yen US dollar, the normal spot trade is dollar yen, not yen dollar. So it's the backwards configuration, the backwards pairing. So you have to be careful if you're looking at the spot. In fact, the trade we just talked about, where we were going to get long at about, I guess our order is in at 101.28 is where we have our bid in. If we wanted to get long in the US dollar versus the yen and we use the options, can anybody think of what could we do to get long if we wanted to get long the US dollar versus the yen, but we had a trading pair of yen versus US dollar? Can anybody think of an options trade that would get us long so that we would be looking for an upside move in the dollar versus yen pair? See if any. Yes, if you Tom, you're right. If you sold the call, the XDN call, and I know that's counterintuitive, but think about it. The yen versus dollar is the opposite of the dollar versus the yen, and there's an inverse relationship between the two. So if you are short the call and you hope that the yen goes down and the dollar goes up, it's the same as if you bought the call on the dollar yen, or in this case, bought the spot of dollar yen. So you have to remember, you have to look at the pair. Am I dollar yen or am I yen dollar? And in a lot of places, it's not. Now, this one was built so that it settled in US dollars, and there's some reasons why they did it. And there are a couple of other pairs that are normally traded as dollar being the base currency rather than the counter currency. You'll see that with the Swissy and the Canadian also, that usually that this XDC, it's usually not Canadian dollar, US dollar. It's usually US dollar, Canadian dollar is the normal trading. So you have to be careful when you're to know what you're trying to do and match the pairs up. As you'll notice that the dollar, the pound amounts, the lot amounts correspond to what we would call, a mini lot. So the British pound, it's 10,000 pounds, 10,000 euro, 10,000 Canadian, 10,000 Australian, 10,000 Swiss franc, and 1,000,000 yen. So similar to, for those of you who trade FX, the what we call like a mini lot. Sorry, the mouse is going crazy. The good thing about these world currency options, they really are right-sized for retail investors. Same thing can be said for the ones in the ISE that we're going to talk about in a minute. But the contract point values, 100 basis points equals $100. I mean, that's even math I can do. Nice and simple. One option contract priced at $2.50 cost the investor $250 plus commissions, but from the exchange's standpoint, simplified, it's $1 a BIP or a PIP, depending on your preference. $1 contract price movement, one option contract price movement of 1 cent equals $1. Again, very easy math. Even I can do that. Expiration cycles really follow what you're used to on the equity side. They are European exercise. The difference being, and I think we touched on this before, maybe not. There's two kinds of expiration for options. There's European and American. American allows you to exercise the option at any point up until and including at expiration. This allows, particularly with equities, the ability to have dividend plays, and there's some pricing advantages to have that right. But with a European exercise, you cannot exercise this contract until expiration. Now, that doesn't mean that you can't get out of your position. If you're long, let's say Tom went out and sold a, oh, by the way, I'm sorry, I'm looking at that. Yeah, Jerry, you would actually get long the put to get short. You get long the put to get long. I know it's crazy, but what happens is, let's say in either of those cases, if you're long a put or short a call, and you wanted to get out of the position, just because you can't close the position at expiration, but you can do the opposite trade. If you're long a call and it goes up, just sell the call back out prior to expiration, no limitation at all. It's just that the exchange settlement does not happen until the expiration. When does it happen? It's the Saturday following the third Friday expiration. Settlements based on the 12 noon Eastern buying rate as determined by the New York Fed on the last trading day prior to expiration. So on that Friday, and they settles in U.S. dollars. Now, you wouldn't be surprised to find out there's an extensive contingency plan. If for some reason New York Fed cannot issue a number, there's a backup plan. I think I'm like the 12th choice. They call me and just I pick a number, but they're never going to get to that one. I don't think that really is going to happen. When did the Philex options trade on the NASDAQ? Equity trading hours, 9:30 to 4. Position limits 200,000. I can't imagine anybody's going to have an issue. Hopefully someday we'll all have a problem and need to get so big that we go right up to position limits. And all trades, this is big, are guaranteed by the OCC. What's that mean to you? It means that the OCC, the Options Clearing Corporation, guarantees the other side of your trade. You don't have to worry about counterparty risk. If the other party to the trade defaults, then your trade is guaranteed, which allows you to have contingency trades. It was part of the reason why when Lehman Brothers went down and some of the other the other banks did not go down in the crisis in 2008, the whole term of too big to fail. Part of the reason that some of those institutions were deemed too big to fail was the domino effect on the derivatives and extended contracts that they had. Their bearing on trades that were intertwined with other companies. The unravel of that could have been the unravel of the financial market, and that pretty much was one of the key factors as to why they had to keep some of those institutions up and running. The world currency futures, which are underlying, they're the hedge for world currency options, run on exactly the same underlying. They're also traded at the Philex, and they're a one-to-one hedge if you wanted to hedge your option position with those futures. You can also trade them standalone. Most people just trade the spot market. Those hours that the options, the Philadelphia Board of Trade, the currency futures trade a little bit earlier and a little bit later, open up at 8:20. Same expiration, same dollar settlement, same guaranteed by the OCC. These are the symbols if you care. They're all 9, so it's B9, EU9, CA9, AB9, SF9, JY9. Don't worry, there's not a test at the end. Option symbols for the ISE, I apologize, this one's a little bit of an eye chart, but what I do want to point out to you is they've chosen, the International Securities Exchange, to have the dollar be the base on every one of its major trading pairs. Now, there are a few where it is the other way, as you'll note, but the majority of their symbols are all dollar versus, and there's the symbol. So the same thing happens. You have to make sure that if you're trading something, for example, the Australian dollar, the pound, the euro, and the New Zealand have two different symbols where it's, for example, dollar versus euro and euro versus dollar. Those would be the exact opposite or inverse of each other when it comes to value. Jerry's asking, are they the ones that you buy your option when you sell it at the market? No, the OCC is not the other side of the trade. They're just the one that stands and guarantees the parties between. So if, Jerry, you and I did a trade, the OCC would guarantee to you that I would deliver, and then would guarantee to me that you would deliver. Let's call them the house, even though I don't like necessarily the gambling analogy, but they are kind of the house guaranteeing all the trades that they clear. So the symbols there for the ISE. ISE options provide investors with additional choices and flexibility to hedge their currency exposure risk. They're cash settled in US dollars. European style exercise can be traded in your existing brokerage account. That's right off the ISE website. I have a friend who's in charge of their marketing there. And so again, similar, if not almost exactly the same as the Philex NASDAQ options, except that the US is the base in the ISE, and it's the counter for the Philex. Same sort of incremental dollars. I'm not going to waste too much of your time, but it's the same idea. Same movement, same multipliers, 100, very similar to what you would have seen at the Philex. FX trading is really sized for retail investors. It fits perfectly into your account. It does allow you the advantage to trade in a volatile market with the risk advantage of options. And what is that? Let's say you wanted to get long and underlying. Let's say you wanted to get long that US dollar yen trade right now, but you wanted to use options. The advantage is that if you pay, and I'm making up a number, $1 for one of the USDJPY 101.50 calls. So right around where it's trading, right at the money option, you pay $1 for it for a one lot. So your risk is $100. Regardless of what happens, you can, no matter how low it goes from now till expiration, it can never be worth less than $0. So all you can lose is $1, but it does give you the ability to ride out some of the swings that, as we've seen in the currency market, can happen on a daily basis. And you can get shaken out of positions because of quick volatile moves, and it also allows you to take a longer view and a step away from a computer and trade it from, say you're working your full-time job, but if you have an options trade in there with a stop and a limit, you can ride out some of the storm without necessarily getting shaken out and having to be in front of your machine. So it really does option work really well. It does trade like a U.S. index option, and a lot of the equity option strategies that you're familiar with are going to work for currency options. I'm going to give you an example. We've got about 20 minutes left. I'm going to give you an example of a trade, how you could replace either a foreign currency future or spot with FX options, giving you a way to manage your trades with the advantages of options. And hang on one second, I'm just taking a look here at the positions. Nothing's trading. Okay, so here's what we're going to do. We're going to show you the example I just gave. Let's say you wanted to get long an underlying, and again, the prices are a little old, but the example still holds. The world currency future spot replacement. So instead of going out and buying a currency future or going out in the spot market and taking a directional opinion position in the market, you would use options. And in this case, we're going to purchase an in-the-money. You would purchase an in-the-money call or put to initiate a long or short currency position versus the U.S. dollar. Now, this is if you were using the world currency options. If it was the ISE, it would be the opposite. Against the U.S. dollar, it would be the dollar versus all the underlying pairs. But if you do this, we mentioned it, there's limited risk. You can only lose what you put in. What's the great line from the movie Rounders? You can't lose what you don't put in the middle. For those of you poker players out there, I'm sure you remember that. I'm also very biased on the movie because the guy's name is Mikey McDermott. No relation. I do have a cousin named Mike McDermott, but I always like that movie. So again, you can't lose more than you put in. So if you pay $1 for an option and you bought a one lot, you can only lose $100 no matter what happens. So your risk as you enter the trade is at the pinnacle of clarity for what you're trying to do. You know you can only lose $100 in that example. And to me, knowing what you can lose and what you're willing to lose, and then determining how much risk is that versus what your reward is the basis of a trading strategy, is a basis of the way that you look at the market. It does allow you for a longer term time horizon. I know guys that trade spot on like the 1 minute chart, and occasionally I'll do that, but it really is mentally difficult, and it can get whippy, and it can be really hard to do. Well, this allows you to step back and start looking at 1 hour and 4 hour charts where the movements kind of even themselves out, and you're not getting shaken out of your position. You know what your risk is, you know where your profit targets are, and you don't have to worry about those interim moves because as long as you still have time to expiration, you have a chance for your strategy to work. It can also help you minimize the effect of the short-term market swings, those back and forth that we've seen over and over again. I mean, you look at a 1 minute chart versus an hour chart, it might not even look like the same underlying because of the volatile movement on a 1 minute chart and the more smoothed out, candlestick bars one at a time on an hourly chart. Here's an example. Now this is a world currency option XDE with the underlying trading at about 153. So what we did here is in our example, it's a little bit of an old example, but it works. I purchased, as an example, 10 XDE July 153 calls. What's that do? That gives me the right but not the obligation to buy the underlying at 153 until that July expiration. The debit to my account would have been $3,500 minus brokerage. We're not going to bother with the brokerage. So instead of, I thought that this pair would go up, using this as an example, I thought the pair would go up, but instead of using the spot, I gave myself, and at this point, July, when we did this example, July was 74 days away. So I had over 2 months to be right or wrong with $3,500, $3,550 on the table. Now, in our example, the underlying has gone up significantly. If you look here, when we did this, again, old example, but the math still holds. You can see our underlying right here is, I can't really see it. I have to get a brighter color. Right there, 154.93. And then on our next page, let me clear that out for you. You can see that the underlying right here is jumped up to 157.91, and it is, let me do it here for you. It's directly down here. So what do we have here? It's going our way. We were right. And how can we do that? Now, let's say you had bought the underlying in the spot or the futures, and you were right. After you did the happy dance and you patted yourself on the back for being a genius trader, how would you make money? What's the only way that you can make money if you bought the spot? What's the only way to make money once it has gone your way if you were long the spot? Well, the answer is you have to sell it. The only way to get the profit is to sell it. You don't have another option. There's no other way to make money except to sell the underlying. Once you do that, you're out of the trade. And you can no longer be right. And you can no longer do more happy dances when you remind yourself what a genius trader you are. But with the options, what I'm showing you is we can now roll out that position. And you see I've highlighted here the August 156 calls are trading at $3.75. So the underlying's going our way. We own 10 of the 153 calls, and we paid $3.55 for them. We're now noting that the August, another month out, 156 calls are trading at $3.75. How can we use that to our advantage? Here's what we did. We purchased those original July 153 calls for $35.50 was our debit. Now what we're going to do is simultaneously, technically it would be a calendar spread, a diagonal spread, lots of things you could call it, but we're going to sell out those 153 calls, but at the same time, we're going to purchase the XDE August 156 calls. So how does that work? Well, the 153 calls are worth $5.60. So we sold 10 of those, have a $5,600 credit. We paid $3.65 for the August XDE 156 call. So now we took a credit of $1,950 on that trade alone. And now when we sum it all up at the end of the trade, or the end of this leg of the trade, we now own the 10 August 156 calls. Again, 156 with the underlying trading at about 157.91 in this example, and they're worth about $3.75. Well, we now own them for $1.60 because we originally paid our original trade in July, $35.50. We did a credit on the calendar spread of $1,950. So right now we're on the hook for $1,600. We now own 10 August 156 calls effectively for $1.60 each. They're currently trading for $3.75, $3.65. So there's profit in there already. If we wanted to stay in that trade, and that's the example that we're using, we want to stay in the trade, we now own August 156. If the underlying continues to move up, we'll continue to profit, could profit all the way up to and including when expiration happens. So I was able to be right do the happy dance, tell myself what a genius trader I am, and then roll the position and stay in it. Keep my risk limited and give myself theoretically unlimited upside potential. What that does is it limits your risk, and that's the advantage of this replacement trade. Allows you to, again, spread the time horizon out a lot farther and minimize the effect of the short-term market. But the biggest thing, I can lock in profits if I choose to. I can lock them in and continue. Now, I could have done, for example, if I had decided that I wanted to do, to own the, now that those calls are worth, my profit was say $2, I could have, in this example, and I'm going to show you what I mean down here, I could have said, you know what, I'm up, let's call it $2,000. It was $1,995, but let's just say it was $2,000. I could have bought these August, right here, the August 158 calls, and paid, let's just say, $2.60. Well, I could have paid $2.60 for them, but I already had $2 in a, let's call it a credit in the spread. So for 70 cents, 65 cents, I could own those calls, minimal risk, and still profit on an upside move. So there's lots of things you can do. Once you're right with the option, even if you're wrong, but more often once you're right, you're able to maneuver more nimbly, stay in the trades, and continue to have the advantage of limited risk. The other thing that you can do is that you can create a cross-rate trade. And a cross-rate trade in general is referred to as a currency pair trade that does not include the US dollar. You notice that the ISE and the World Currency Options at the NASDAQ Select all had as either the base or the counter the US dollar. When we talked earlier, one of the trades we spoke about was the euro pound. Well, that's really a cross-rate trade because the dollar is not involved. You could, in theory, create a cross-rate in the options, even though there's not a listed option that trades. Now, again, it's a little bit of mental gymnastics to understand exactly how to do that. And I don't want you to go out and try to do these trades with this. I'm just trying to open up the idea that you could do this as part of trading beyond having the dollar being the base or the counter for every trade that you do. Some of the examples of active crosses, I just mentioned one, the euro versus the pound. The euro yen does also trade. The pound Swissy and the Aussie yen are three examples of actively traded cross rates. Again, cross rates being a currency pair that does not have the dollar in either. Daniel just asked, what if option goes against you? Well, if you're wrong and all you can lose is what you've put in. So if you bought a call, paid $1, and you bought one, you would have $100 at risk. And if you were completely wrong and the underlying went exactly the opposite way and it expired, worthless, all you can lose is $100. So you've got the built-in protection of having the limited risk. So they don't always go, I wish that went for you, they don't, but if they go against you, you do have the opportunity to limit the risk as you enter the trade. Let's use the PHLX for the example for our world currency options. Gives us the ability to create a synthetic cross-rate option. And what do I mean by that? Again, we talked about the cross-rate pairs, the underlying. Well, now let's create an option that will act as if it will be the synthetic version of the cross that we talked about. So these are the spot crosses, euro pound, euro yen, pound Swissy, Aussie yen. Let's create an option that will act as if it were and is the option for a cross rate. Even though we don't have one traded, what would we do? We would buy a call and a put in different currencies. We'd get long one, we'd get short another. Here's the example. We could buy the XDE call and buy the XDB put in ratio. The US dollars on those trades cancel out. We would create a long euro, short pound position. And here's some more detail on that. In this example, the euro pound cross is trading at 157. Again, old example, but still works. The pound dollar cross is trading at 198. Well, we need to figure out what ratio do we need to do this trade to make it match the underlying. So what we do is a little bit of math here. We take the 157, we divide it by 198. We find out that 0.7929 pounds will equal $1. So once we know that, we do the same. We use that same ratio to create a trade that will mirror the underlying. Yes, you can get these Forex options in Thinkorswim, Kim. I'm a big fan of Thinkorswim. Dan, you know, naked options would mean you'd be short the options. Never, ever, 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 ever. I'm going to suggest never sell naked options. Buy options all day long. Do not sell naked options. And yes, Thinkorswim is pretty awesome with the FX options. The rate we would need here, if we were doing the Aussie-Canadian cross, again, Aussie-US is 87, Canadian-US is 94, and what we're going to do is create find out the ratio. 87 divided by 94 gives us 0.9255, so it's going to take 0.9255 Canadian to buy $1 Australian dollar. And here's our ratioed example. World currency ratio example. If we had 10,000 euro at 157, again, the example we're using, and 10,000 Australian at 0.96, we need to establish the ratio with approximately the same amount of, again, US dollars. That's the common currency in the cross. We would buy 6 XDE calls at 157, buy 10 XDA puts, the 96 puts, and what would that give us? We would be long approximately $94,200 versus the euro, and short approximately 96,000 of US dollars versus the Australian dollar. So effectively, with the same amount of US dollars at risk ratioed. This one also works where 10,000 Australian versus 10,000 Canadian. We establish the ratio. We figure out that we need to do 22 of the XDA 87 calls versus 20 of the XDC 94 puts, which gives us about 191,400 US dollars versus the Canadian, and we're short about 188 US dollars. Long the US dollars versus the Australian, short the US dollars versus the Canadian. What's the advantage of this cross rate? It's a directional trade with, again, those built-in risk management of owning options. It's a volatility trade. Sometimes you can find the volatility advantages of trading, again, more of an advanced options trade, but sometimes you can take advantage of volatility in these trades. And it's a lower cost a lot of times than owning cross rate, particularly the futures. Futures can be expensive, so it may be more cost effective for a retail investor. I appreciate everybody being here with us this evening. We're right up against 9 o'clock. I want to remind everybody, I would invite you all to come back, visit me next weekend, next week, Monday and Tuesday, March 24th, March 25th at 5 and 8 p.m. We're going to do 4 hours of training. We're going to talk about options. We're going to talk about equity options and currency options. We're going to talk about foreign currency trading. Brought to you by our friends at FXCM. A fund account with FXCM. If you have any questions at all, please reach out to the team at Cyber Trading University. It's $37 to be part of that class, and gives you the opportunity to use, you saw me using earlier my demo account. That's the MetaTrader platform that is offered by FXCM. It's the gold standard of trading currencies. That's the platform that everybody uses, and it's really well done. The people at FXCM have been doing this for a very long time. It's a great brokerage firm for currencies, and we hope you'll reach out to them, take advantage of their demos available, take advantage of opening up a trading account with them, and then come back and visit us on the 24th and 25th. I really look forward to seeing everybody then. If you have any questions, again, it's Cyber Trading University. It is up in the window. And if you need anything from me, you can reach me at gregm@ctutrading.com. I will throw that in the window right now. Guys, I really appreciate everybody being here with us this evening. It's been a pleasure for me. I always like getting online. you can be quite sure that if you follow those 3 trades that I showed you, you'll all probably be laughing at me in the morning. I'm used to that. Again, Fausto's fond of saying, don't judge me on my winners, judge me on my losers. And the idea is you go in with a plan, know what you're willing to lose, what you're willing to risk, and what you're trying to make while risking that. And if you come up with a solid plan, hey, you're going to lose some. That's the way things go. But I'm going to take the opportunity now to sign off. I appreciate everybody being here with us this evening. Please reach out to our friends at FXTM. If you have any questions at all, you can reach the team at Cyber Trading University, or you can reach me directly. Everybody have a great evening. Thanks a lot and good night.